All right, welcome to the party, Russell 2000. Russell 2000 has joined us in a big way, and they're not the only ones. Energy has joined the party, industrials has joined the party, financials are starting to come around. So we're going to talk about the implications of all these laggards that have finally come around and have had a good start to this week, and what those implications might be for broad market, and including all this string of opening gaps, relatively large opening gaps, with today's 2% plus opening gap that we had to the upside, and what those implications are. We talk about that as well. We break down what's kind of driving this price action from how these different asset classes, whether or not the risk appetite trade is joining the party, and whether the safety trade unwinding has begun. And then today's trade idea takes a look at one of these stocks that has been so beaten down that's created a huge gap of volume that we can trade in for a while, like for months for a while, through some ups and potentially some short term or maybe even intermediate term downs. So we're going to talk about that and how to trade it. So let's go ahead and get started. Today is Wednesday, April the 29th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with our market forecast indicator. So you can see nice rally today, gapping up over 2%, by the time we started. This is the sixth day of a run here. In fact, if I throw on this gap study that one of our market scholars, Clarence Carr, put together for us, you can see the big move up, more than one standard deviation. In fact, the second gap of over one standard deviation move to the upside in the past 6 weeks. And all of these, including this one, this is actually need to go to SPY to see this. All of these, including here, a 0.5% higher or more. 0.5% higher or more gaps to the upside. So pretty decent move here in the last week plus, and a lot of it coming overnight, right? A lot of that move coming overnight. Very small ranges trading. In fact, most of the move during the days have actually been down days. Whereas if you look at the upward move, see very small body there, very small body here, very small body there after a gap up that we still haven't filled that one in yet, and then very small body there after a gap up, 2% gap. So you see 1, 2, 3, 4 really small bodies on the up days, and then two down days in there, covering a lot of the ground, filling in a couple of those gaps. In fact, we filled in 3 of the 6 gaps. We haven't filled in this open one, the middle one, or this middle one, or this last one so far. So interesting how, again, you consider how much volume goes on in the after hours market versus how much volume goes on in a regular session. It's extremely light. So just something to kind of keep an eye on. Again, we've looked at these before. I think I must have deleted them, so I'll bring this back on. If you take a look at the move that we've had here, and I'm going to make sure I snap this. Okay, it snapped. So I'm going to snap up here to right. Right there. There we go. And then snap down here to the bottom. So there's our high, and there's our low, and you can see now we are at the 62% Fibonacci retracement level. In fact, if you take a look here on the long-term chart, but then switch it to a daily chart, you can see we are right at the 200-day moving average. So we filled in the gap between the 15 to 200 just like that, and now we are hitting the 62% Fibonacci retracement of the decline, the top of that Fibonacci retracement zone, in other words, of that resistance area, and this 200-day moving average. And if you look at the Bollinger Bands here, we are right up against this big volume node. Like we're actually down at this one right now, which is right. I mean, they're right next to each other, and that's just slightly higher because that's where the point of control is. But you can see not very much higher because that's a pretty big volume node in and of itself where we're at right now. A lot of this rally has occurred because of IWM filling in this gap, right? So here on Monday, after this nice breakout on Monday, it has been filling in this empty gap of volume to the upside. And it actually still has a little bit more room to run, except we're right at the bottom of the value area. So we'll see if that ends up holding there or not. Going back to these RSIs I've talked about before on the S&P 500, again, getting above 60 and getting above 200 is really important. We have done that on the NASDAQ. We'll go to the NASDAQ 100. We have gotten above 60, haven't been able to hold it. And then today you notice the Russell got above 60 in a big way and got above 200. So a nice little breakout there that we're looking for across all these indexes on the Russell 2000, which is interesting because that's the one that's been lagging, and it finally caught up and even so far as of right now surpassed. You can see the Dow looks very similar to the S&P, unable to really break up yet in the area that we need it to. We've looked also at the DMI here. Take a look at the DMI for SPX. We are crossing above 30 and we are dropping below 20. Again, just today, so we'll see if this holds or not. And if you look at the Russell 2000, big time break above 30 and drop below 20. So, we'll see if this holds, right? When you get that breakout, it's got to hold more than a day so it stays. But good sign, at least from the Russell 2000, it's a good sign. But it's been such a laggard that it's not surprising that you have a bullish move where the laggards catch up to what? In fact, a lot of what we've been gaining today, I've shown you before, but a lot of the biggest moves that we've had over the last little bit here. Let me put on the S&P 500. Whoops. Yeah, no. It needs to be this S&P 500 here. There we go. You can see, biggest winners today, Norwegian and Royal Caribbean and Carnival Cruise Lines. A lot of these energy stocks rallying up, over 15 plus 20%. United Airlines, Delta Airlines, American Airlines. We did a trade on Delta Airlines for our class portfolio. Our premium subscribers get those trade alerts, so make sure you check that out for something I sent out before the market close. And then you can see some others, Micron down here and Harley Davidson. So some of the bigger losers throughout the past couple of weeks, they've been the biggest winners. So again, the laggards catching up. We've had leaders kind of leading the way in those big tech QQQ type names. They've been lagging now, and the previous laggards have been picking up the slack. And we'll see if that ends up being kind of a sign that this move might be a little bit undone to the upside here, at least in the short term, right? At least in the near term. I've compared in the past, so let me go back here to max available, and let me just make sure that I've got log scale. Okay, good. So I'm going to zoom in here and give it a second to finish filling in. I think we're pretty much there now. So let's go. Nope, not quite. It's got to get to 1929. There we go. All right. So if I zoom in, so you can see this 1929 time frame here. So we had the big drop. We rallied up to the upside, and then when we actually pulled back and retested, you notice we didn't retest all of the low points here. We came up. This is obviously just closing values. But we came up towards that 50-day moving average, held it. In this case, it was just a 50, and we're up to 200 right now. Held it, and then rolled our way back down and filled in some of these gaps, but not all the way down. Not these last couple of really big down days. We had recovered those with that one day, and then, of course, we pulled back down to this level. So here's an instance, and again, we rallied up for a while from there, so you can see the trend to the upside from there was pretty good for a couple of months. And that actually got above the 200-day moving average when we rallied up. So it's interesting that even in the worst of worst, we didn't necessarily come all the way down and test these lows, and I don't think we're going to come all the way down and test these lows again either. But if you notice, if I were to activate, we've got this Fibonacci lines. If I were to edit, and put on these kind of smaller levels here, so this one and then this one. So again, if we come down to here, we can still like that. When we break back down below the 23%, that's when a new leg of the bearish trend gets going. So I don't think that's going to be the case. I think actually we'll come down towards this, fill in that last gap, come down towards this area. If whenever the case may be, it might take a while, and we saw that it took a while in 29 for that to occur. But once we break above this level, then that's the move, and that's this old high over here that happens to line up with this old high. That's when you're back to a bullish move again, where the trend now, we're not just filling space, now we're trending. If you notice in the NDX, which is the one that's been the most bullish out of all of these, if I were to throw on the Fibonacci retracements for the NASDAQ 100, and let me pop this up so I can see a little bit better, all the way down to the low point. And then now kind of reset these lows. So auto, there we go. So reset these lows, and you say, okay, well, how far has it gone up? It's gone through the resistance, the 62% area, but has it broken through the 78% area? And you notice that it hasn't, right? It's gotten up to getting above 9100. In fact, it's gotten up to this old peak in this area here, and it's kind of stalling. Over the last couple of weeks in this, with some up and down moves and a little bit of a divergence setup. But that's the key level to break back up through 9100 to say, okay, here we go again. And of course, the Russell 2000, when you look at it, it's had this move. So put that right there, all the way down to that low point. We're still in the Fibonacci retracement zone. We're in the upper half of it, but we're still in the retracement zone, so it's not even close to where it would peak. And you remember that's where that significant Bollinger Band support or resistance level is, the point of control is for the Russell. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. Also, hit the thumbs up icon that's down below your video there. That tells us two things. Number one, you liked your video today. Number two, it tells us that you want us to do the video again tomorrow. It's a quick way to give us feedback. If you don't like our videos, you don't have to click on anything. If you do like them and you want us to let us know, you can do it really quick with one click, just right now while you're watching. Also down there, comment. What did you get out of it? What questions or comments do you have about the video today? You can post those down below. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow us on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, you can see some of the other things we have going on. Check out our classes, our Market Outlook Live. We've already done today's trade idea before the market close. We do those every day at 3:30, or every day I do these videos at 3:30 here. We also review all the old trades and continue to manage them until we close them. So if that's something that interests you, you can check those out here. Just click on this image, or you can go to our Market Outlook Live trade review right there as well. Those are at 3:30 Eastern Time, again on Monday, Wednesday, and Fridays. We also invite you to engage with us on social media. Click this little heart. It opens up your window. You can like today's Market Outlook tweet. Click that thumbs up. Opens up your Facebook page. You can like today's Market Outlook Facebook post. Again, that benefits us because the more likes and engagement these posts get, the more these platforms will promote it to all of our followers. And it benefits you because the more these platforms will promote content to you from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, now let's get back to the charts, and you can see from a long-term perspective, remember how important it is for us to get a close up above these highs. Well, look at that. So, I mean, that's really bullish. To get a higher high, to get a higher close, to not get a lower shadow. I mean, that's bullish enough. The final straw is to close above these highs, like we did over here, where we closed above these highs. A few weeks ago on April the 6th, and we've continued higher. Now, granted, that was a big move on April the 6th here this week. So we haven't gone up as much since then, but we've remained bullish, right? And as of right now, looking pretty good. For the, going into 2 more days left in this week. We are sitting right at that 200-day moving average, though, so something to kind of keep an eye on going into Thursday and Friday as we finish up this big basket of earnings. We did get some pickup in volume today, still well below the average. And again, small range, but we talked about that. You have to add on when you add on the range from the overnight trading, then it gets to be a little bit above average, and that's what this chart shows you. This chart here, it shows you that when you add that on, but still, you consider 3% of 300 a 9-point move, and so we're right there, still right at the ATR is right there at about 3%. And again, I've shown you before in the past. When you go all the way in the past here, when we haven't had very many of these big moves that extend beyond that 5% mark, but we tend to come after we hit 3%. That's when we get the new leg lower, right? And we form the low point. Now this was a lower low, and then you go out to like say 1987, which was right. I need to go out a little bit further. Nope. Oh, I need to go to SPX. That's why. If we go out to 1987, so give it a second to finish loading up, right here. So another instance where we got up above that 5% mark. We came down right to there, and here, let me do this. Take off the fit high and low and use the log scale. So after we hit this 3% mark right there on the way back down, that's when we retested the lows. And here we were consolidating that whole time. Here we dropped down and hit those lows. We dropped and we didn't go lower, we hit those lows. And then of course in 1929 is the other instance where we got up about 5%. And then again as we came down to 3% here, then we retested the lows, but we didn't go all the way down in this case. And this is more likely because we were so bullish on the way back up here. This type of pullback is more likely than what we saw in 87 where we consolidated, or even in 2008, 2009, where we never even really got to the 50-day moving average, where we had dropped so sharply over here. So we didn't really, remember, we're touching the 200-day moving average as it is. We didn't really jump up at nearly as much by the end of the year, and you can see the leg lower. So I see this as the least likely scenario, and of course, if we do follow that, that's 2100. That's where we'll have some support, long-term support. If we do the 1987 scenario, then we're going to come down here. But if we do the 1929 scenario, then as we saw with the Fibonacci's, that 23% level is right at this area. So we'd come down here, fill in these gaps, and stop there. That's in my opinion, the more likely scenario, and would kind of fit that 1929 model. And then after that, we were bullish for a little bit. Now we might not go all the way down there. It might be pretty quickly, like once we drop here. So we might get the 3 red arrows and kind of bounce right off of that low point. So it kind of depends on, and you'll probably see if and when that does happen. We don't have it here, but that 2 standard deviation gap to the downside usually is kind of like that last straw. So we'll see if that ends up being the case if and when we pull back anything and get this intermediate. I would venture to guess the intermediate line would come back down at that point, and if not get below 50, get pretty darn close, something like this here. But this is kind of more the expectation that I'm looking for, is that kind of drop. We roll back over, probably hit the market sentiment by then, and then bounce off of it and head back up. Again, you look at like the Ichimoku cloud, and you see, okay, how's the Ichimoku cloud trading? We're well above, and so to get back down here, we'd have to dip into the bottom of the cloud essentially to get down to that level. And right now, we're on a really strong bullish trend according to that. Now SPY is not quite there, but it's getting pretty close, right? It's got to get above 80 and above 5, and then it's to the point where SPX is. And for that matter, where QQQ is, which is already there, and IWM is catching up. See, it's been so far behind. It's just barely gotten above its cloud, and it's still in that zone where we're not quite strongly bullish yet to where we can start an extended trend without a intermediate pullback. All right, now let's take a look at the intraday chart. You notice there's the gaps, right? So here's the first gap, And this one got filled in by the end of the day. This one got filled in immediately. Then we had that gap that hasn't been filled in yet. We had to get below yesterday's low point for that to happen. And then yesterday's gap did get filled in. And then today's gap, which hasn't, right? We gapped up to where yesterday's high point was and gone right through there. So higher high and higher low. And you can see well above the value, the point of control above. We're pretty much above the value area on the 4-week range, which is not too common. Again, you can see how spread out 50 some odd points stretch is between the low and the high, and we still got a couple of days, and it will move up a little bit after this tag comes up. It'll still be really another 3 more trading sessions before we move it up to this point, and then another 4 trading sessions before we move it up to there, and then it will take about 5 or 6 more, so another week plus to get the low point up to here, and then it will we'll kind of hit this point and be there for a while, and that's at that point we really kind of tighten up, relatively speaking, at least below the 10% mark, and that will open up some more upside potential. The question is whether or not we'll come back down to these levels, and be testing those lows by the time that happens. Again, that won't happen for about another week and a half, because you got to get, this is today's, you got to get tomorrow, Friday, Monday, Tuesday, Wednesday, Thursday, by next Friday, by the end of next week, it's about a week and a half, our low point will be in this area, right, where that brown line is going to be. The question is, what do we do up here for the next week and a half? Do we fill in gaps? Because that's the expectation. And for that matter, we still haven't filled in this gap yet, which is the gap that we're kind of watching to fill in eventually. Remember, that's where the 23% Fibonacci retracement line is down here. So if we do pull back, that's about as far back as we expect that we will go. If you go out a little further on this intraday chart, there's when we pull back down into the spot, there's some volume here that we can hold up in this area before we do eventually take back off and fill in space, and that's all we would be doing, right? We would just be, as you see with the Bollinger Bands, we can come all the way down in here. We'd still be there's that volume node there on the 1-year chart, and then we'd be down towards that lower band, so we'd be filling in space, just like this rally to the upside so far has just been filling in space. We haven't really shrunk the space yet to get a good trending move going to the upside. Same thing on the Keltner channels, right? The Keltner channels, you can see we filled it. Now we've kind of finished filling in space because we got right up to the top end of that Keltner channel. Still haven't crossed up above it. If you look at IWM, we actually did. So this is a nice little breakout. We had come up, we filled in all that space. This is a big time breakout move. If you notice, QQQ had done that over here briefly, and we're still kind of at the top end of that channel. Just again, a move you can see where we can come down to and still be just in the filling space mode. You saw the volume and the trading range and how they related to this, and we talked about this move now that we got down to the 3% mark. If you take a look at the volatility index here, you'll see that we gapped down in volatility, and then we kind of stayed flat all day long. So again, most of today's volatility drop occurred overnight too, and we're still kind of at this area. In fact, if you look on the daily chart, you can kind of see where we're stalling out here on the VIX, right around this 95% mark relative to VXV, and that's an important level. As we've seen in the past. Sorry, that's a 4-hour chart. There we go. This is an important level because, as we've seen in the past, very similar to the 3% mark, very similar to the 3% mark that we saw on, when we hit this is when we hit the 3% mark, right? When volatility dropped. In this case, we dropped down to about 40, but the VIX, we had dropped down to this 95% mark, and then we had the rally up. Now, when we hit the low point, you notice we didn't rally back up. So volatility is not going to run sharply, and it took a couple of months. But you get the idea of why this level is so important. Breaking through 90% now we're just trending bullish. But if we hold in this area, especially around this 95%, we start to bounce back up. And as you saw in 08, 09, we bounced back up here, back to the 100 to 105% mark as we ultimately formed that second leg lower. This one went to a lower low, and I don't expect we'll go to a lower low on the S&P itself, but the volatility still ramped up on that second leg lower. So with that being said, just to summarize the charts before we look at these other relationships in our trade idea today, the trend is bullish. The trend is strongly bullish, and the Russell has finally joined the party. We're wondering if the Russell ends up being that nerdy kid who comes to the party at the end when it's already over. So they show up too late. That now they're here and everybody else is already leaving, as we saw some of these other stocks. Now, in earnings has kind of brought some people back to the party, but the question is, did all these lagging stocks, underperforming stocks, have they joined the party a little too late? So that's the question. That doesn't necessarily mean that we're going to like tank here or any kind of or fall off any kind of cliff. But in terms of some resistance in this area, we've seen some multiple levels of resistance, whether it's volume or retracement levels or old high points or whatever the case may be, and we know how far down we can move and still remain pretty strongly bullish because of the trend that we're on, and just kind of pause and consolidate and lead us up. It'd be ideal if on any kind of pullback move, second leg lower, that QQQ participates a little bit more this time, because we'd like to see some more value created in some of those stocks. That can lead us up higher for a longer period of time going forward from here, because we know PE ratios are going to shoot through the moon as these earnings drop. So we'd like to see some of the price drop too, so the PE ratio moderates at a much better level that gives us more leg room to the upside to move ultimately over the next year or two. So what do you think? Do you agree with that? That technical outlook? Do you disagree? There's a link popping out right there on the top right corner of your screen. It opens up a poll. Hit either agree or disagree. If you click disagree, comment down below as to why. What are you seeing that either makes you more bullish or more bearish than what I came up here through our daily market outlook routine? All right, now let's take a look at what's driving this price action. I want to take a look at the asset class comparison chart. Again, you can see the safety trade that we've been in and how drop, and you can see the little rally over the last few days. And so I want to take a look at that last few days, pretty much all this week so far of this move. And you'll see small cap stocks really, that's a 10% gain in 3 days, including the opening gap on Monday morning. A 10% gain. Now consider if we fill in that gap, then that's a pretty decent drop in the S&P, because it was up 4% before the late drop at the end of the day. On the other hand, crude oil, now we all know the issues with crude oil, but how negative it's been, and you can see the safety trade's down 1%, not significant, but not rallying anymore either. You can also see international stocks outpacing the S&P too, so that's a relatively positive sign for this little rally. So in other words, like, things that were lagging going into this, if you take a look, going into this rally, going into let's go into the close on Friday. Well, we'll go through to the end of Friday, and then we'll go to the beginning here. So including the gap on March 24th. So you had the close on March 23rd. We gapped up from there. Then you can see initially the S&P was rallying and international stocks lagged, and you can see now how they jumped up, and they were the laggers, and now they've rallied, and the S&P and real estate fell. They're still up over this past few days, but they're not up as much as some of these others. And you can also see too that going into this, gold was up and bonds were up, and they're down a little bit today. So you can see it's a little bit of a, that we've had some leaders, and now some of the laggards are kind of catching up to it in a big way in the past few days. The IWM was up 22% already, so not lagging too far behind. But then when you go through the end of today, let's go through the 29th. There we go. If you go through the end of today here, then you can see, holy moly, now it's up. Now it's made its way past the even real estate in the S&P 500. and is now up 35%. So big time move. Whereas you can see not being reflected everywhere. I mean, if you take a look at the daily chart, we've been so bullish on equities. You would think that yield should be also kind of rallying, and as usual, some of these other asset classes are not quite taking advantage of this renewal of risk appetite in the 10-year yield, and in crude oil, and of course in the dollar. That needs to be bearish, right? The dollar, the stocks go up more when the dollar is down, and we've had a little bit of a pullback here, and that's one reason why stocks have been as bullish as they've been. We are oversold in the short term, and that has sparked a bounce the last couple of times in the dollar. Now the question is, will it spark? We've coiled here. Will it spark a bounce up to new highs and beyond, or will we break down and start this dark pink shading and red line pattern, which would actually be really bullish for equities? Generally speaking, it's not the most bullish sign for stocks do better when you're in a dark pink shading and red line format for equities. That's the better pattern for equities. It's not as good to be in the dark green shading and green line. So it is a little bit of a positive to see us rolling over, even if it's just a little bit. On the long-term chart, you can see not necessarily the case yet. So really bullish for equities here, not as bullish. And we talked about the bear market in equities starting at the beginning of 18. Well, that's where the dollar bottomed out. It's been rising ever since then. And again, typically, coincides with weakness. You can see in 2015 and 16 where we had kind of a global slowdown and the U.S. markets kind of stalled, and we had that double dip death cross. That was with the rise in the dollar, and we kind of had that late push at the end of 16 with the elections, but then with the drop, we had some really good rallies coming out of that. And you can see in 13 and 14, when we were in the throes of QE3, we had a downward move on the dollar that helped propel equities into a good, strong move to the upside. So similar move here would be very strong, and we're getting, kind of some signs, some relative signs that we haven't gotten in a while on the turnaround here, and we'll see if that persists a little bit longer so that the bullish posture can maintain. Otherwise, if this short-term sentiment bounces, then you would expect that would lead to some, at least in the short term, some weakness in equities. All right, if we look at a sector standpoint, the sectors have been really rallying too, and you can see healthcare continues to be a nice, good leader. But let's take a look at the last few days there and how the market has performed from the beginning of the week up until now. And take a look at the big winner, right? Energy stocks have been, even with crude oils down, energy has been the big time winner here, up 12.5% this week alone. Financials, industrials, those cyclical areas have been lagging behind, right? We've talked about, how those are kind of economic growth sensitive areas. They've been the biggest laggards during this rally we've had off that March 23rd low point. Some of our big winners were healthcare and utilities and real estate, and here's all your FANG stocks here, and XLY, C, and K. They're all kind of matching the market, if not lagging a little bit. So again, the late to the partiers are coming, and the party's already been growing. It's been going great, and now you've got some people showing up saying, "Hey, can we come in?" And the question is that party over with already? Have people already left the party, or are they just now joining, and we've still got a good night left to go? That's the big question mark. And the reality is, a lot of times when you see these big moves, that when you start to see the laggards catch up, that means that we're running out of gas on this move. Doesn't mean that the bullish trend is over, right? We might have a new leg, but remember, these are the things we want us to lead, like not necessarily these, but like on small caps and value stocks, international stocks, we want them to lead us off of the low point going forward from here, and they haven't led us off of that last low point that we had. And now the low point might be higher than that last one that we had in March, but we want to see those asset classes lead us up. We don't want to see these other asset classes lead up and then have these areas catch up. right? They need to lead us up, and these areas, the large cap stocks, the growth stocks, they're the ones that catch up at the end of a long-term bullish trend, right? Whereas we start off with that small caps leading us. So it's kind of interesting to see, they caught up in a big time way, and that's why the Russell's doing so well, because the Russell's kind of full of these stocks, financials especially. Energy's been associated with them, but financials and industrials especially, those small cap areas catching up, and that's why you see such a big move higher in the Russell. All right, now let's take a look at our trade idea of the day, and it actually happens to be in this energy sector. And again, like we saw with other trade ideas, this stock showing a lot of the bullish patterns that we want to see on the S&P to kind of say, okay, here we go. One of the ConocoPhillips is the trade that we're looking at. A day after getting an overbought cluster at the beginning of a bullish trend, intermediate trend, very good sign for this energy stock. You can see starting to fill in a gap here with this little breakout that we've had today. If you take a look at its long-term chart, you can see how much room it has to go, right? So we have some pretty decent room to fill in that gap below. When you get above the 50, you start to fill in the gap up to the 200-day moving average. So some pretty good room to go there. You can see obviously it's got 3 green arrows, and we're rising in that momentum. If you look at the 2-line version of that chart, you can see we're getting some divergence here. The 8 days pulling away. We're finally getting up to higher levels on that MACD. If you take a look at the RSI and the CCI, they are breaking above 260. So you can see that gap again right there. If you take a look at the DMI, you can see that it has broken up above 30, with the negative index down below that level. If you take a look at the Bollinger Bands, you can see a huge gap in volume that we have, and not only to fill in that gap, but even all the way up to at least 54, if not eventually up to around 60. So big gap in volume that we can now kind of fill in for a while. It might take a while. It might not fill in as fast as we fell, but it's got some good potential room to move to the upside here. If you take a look at its trend strength indicators, we're almost above 5 there, and we are above 80 on this one. So we're getting closer to getting through the cloud with earnings coming up this week. So what I've done is I've gone out in time to avoid the earnings volatility drop associated. I've gone out in time. I also went below 40 in the delta when we first got into this, and we position size around 1 standard deviation move. Position size around the normal risk, even with that earnings coming up, because of the time element that we have, and because our deltas are so low, that if earnings does play it really negative, then we can get out again. Worst case scenario at a normal risk. Best case scenario, we can get out, I feel like, pretty easily at half of that, and then give ourselves some good move potential to the upside if we keep going up, if the stock keeps rallying through and all these bullish patterns play out. So again, and it's an August expiration, so even if there's some short-term weakness, we can stay in the stock, right, and still ride through some ups and some downs for the next few months, pretty much all the way through the end of the summer. So it allows us some time to be bullish in the more longer term, and then give us some positive deltas that we can be bearish against in the short term if we end up pulling back and the market itself pulls back, that we can add some bearish trades to help alleviate some of that on the downward move. And again, those of you who are of our premium subscribers, if you have our Telegram, I did some of those again right before the market closed here to try to take advantage of this rally that we had into the close and that pullback. I looked at some bearish trades, add some bearish deltas in the short term for us, while we add all these positive deltas in a more longer term. All right, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. It takes you to our Market Outlooks forum. You can open up any new thread, comment on, or have any questions about what we talked about today, reply to anybody else's thread, and let's keep this conversation going in our forums in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter for more content between videos. Join our Market Outlook Facebook group as well as our community at marketscholars.com. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.